Good morning, everyone. Thank you for joining. I appreciate you being with me. My name is Kyle Johnson. I am the owner and a wealth advisor for Link Wealth Strategies, a financial planning firm based out of Topeka, Kansas, that serve clients all around the country and have another office near Independence, Missouri. Today, I'm going to speak to you about savvy Social Security planning and some of what we at Link Wealth Strategies believe baby boomers need to know to maximize your retirement income. When your parents retired, they probably didn't think too much about Social Security. They just went down to the local office as soon as they turned 65 or maybe 62 if they retired early, and they applied for benefits. Social Security has evolved to be more complex than it was when first introduced in 1935 under the administration of Franklin D. Roosevelt. Because of this, baby boomers are approaching the Social Security question in a different way than their parents did. As I move along in the presentation today, you'll likely have a question or two come to mind. If that's the case, don't hesitate to type it into the chat feature at the bottom of your Zoom window. And Creighton Beamer, one of our excellent teammates here at Link, will help me coordinate some time to answer them at the end of the presentation. Now, I must say that while I'd love to answer all of your questions during this time, I've allotted 30 to 40 minutes for this webinar to be respectful of responsibilities we all have during the rest of the day. If we don't get to your question, I promise we will follow up with you to ensure we have addressed what you have asked. If you would rather go another route and submit your question to us by email or give us a phone call, you're welcome to do that at the information provided here on the screen. Now, most people tend to minimize the value of Social Security. If they understand that they are likely to get something back from the system at all, they think it will be minimal amount, not really enough to count on. But Social Security is more valuable than most people realize. One important thing to understand is that Social Security is one of the few sources of income that you cannot outlive. If you're worried about running out of personal assets in your old age, you need not have that fear with Social Security because it continues until you die. And of course, the longer you live, the more you will extract from the system. If your benefit starts out at $2,000 a month, you live 10 more years, you will receive $300,000 in lifetime benefits. If you live 20 more years, you'll receive $600,000. And if you live 30 more years, you'll receive over $1 million during your lifetime. Now, this assumes an annual cost of living adjustment, or COLA, C-O-L-A, of 2%. Social Security offers annual inflation adjustments. So if your benefit starts out at $2,000 per month, and if annual cost of living adjustments are on average about 2% a year, in 10 years, you will receive $2,438 per month, or a raise of $438 per month, almost $6,000 a year. In 20 years, your benefit will be $2,972 a month, almost $12,000 in growth over the course of those 20 years. And in 30 years, your check will be $3,623, about an $18,000 growth because of cost of living adjustments over the course of 30 years. Now, there's no way of knowing exactly what the future cost of living adjustments will be, but 2% is a reasonable long-term estimate that we often use for planning with our clients. Now, when your Social Security benefit is calculated, it will be based on two things: how much you have earned over your working career and the age at which you apply for benefits. The formula for calculating Social Security is pretty complex, in my opinion. You may or may not want to follow along with this, but some people find the formula interesting. In a moment, I'll show you a couple of ways you can estimate your own benefit if that's something you'd be interested in. The general process goes like this. First, Social Security looks at your annual earnings over your entire lifetime. They index those for inflation, and they pick the 35 highest years of earnings to include in the formula. The indexed earnings are totaled and divided by 35 to come up with an average. AIME, right there on your screen, stands for average indexed monthly earnings. If you don't have 35 years of earnings, the missing years will be filled in as zeros. Now, I personally feel like that is the easy and most straightforward part of the process. Here is the more complex part, in my opinion. On this slide, I have provided an example of how the benefit formula would work for a baby boomer who was born in 1960 and who earned the Social Security maximum every year since the age of 22. So this individual made a lot of money over their working career, great annual income. His average indexed monthly earnings, based on what we talked about in the previous slide, would work out to be $11,430 a month. Now, if you remember, that is his earning history taken the top 35 years and averaging monthly income and then adjusting for inflation. Okay, now here's the complex part. In calculating his primary insurance amount, according to the formula on your screen, the first $1,024 of the $11,430 of his average index monthly earnings, that would be multiplied by 90%. Now I'm just going line by line down this formula. The amount between 1,024 and 6,172 would be multiplied by 32%. And finally, the amount over 6,172 would be multiplied by 15%. The Social Security Administration calls each of these lines that I've shared with you bin points. They calculate, or they total the calculation of each of these bin points to come up with this gentleman, in this example I've provided for you, his primary insurance amount of $3,357.60 per month. This is the amount that the worker would receive at his full retirement age. Now, I told you this was complicated. Fortunately, you don't have to figure this one out on your own. But let's review when your full retirement age is. Some of you may know already, but your full retirement age is the age at which you can claim full unreduced benefits. It used to be 65 for everybody, but now as we're seeing higher full retirement ages being phased in, it's a result of an amendment to Social Security made in 1983. And really an attempt, in my opinion, to allow for solvency in this system in generations to come. I would not be surprised, and this is just in my opinion, of course, if further amendments are made for my generation and millennials and so on and so forth in order to extend the full retirement age to continue to provide this benefit for generations to come. As you see on the graph, everyone born between 1943 and 54, their full retirement age is 66. Everyone born 1960 or later, their full retirement is 67. And just to make it a tad more complicated for those born between 55 and 59, your full retirement age is 66 plus some number of months. Now, remember I said that your primary insurance amount is the benefit you'll receive at that full retirement age. So what happens if you apply for Social Security before or after that age? In this situation, as you can see on the graph, you will only get a percentage of your full retirement age amount if you claim it before your full retirement age. If your full retirement age is 66 and you apply at age 62, you will only receive 75% of your primary insurance amount. At 63, you'll only receive 80% and so on. If your full retirement age is 67 and you apply at 62, you'll only receive 70% of that primary amount. And these amounts are actually prorated monthly. So you can apply anytime after 62. So 62 in 3 months, 62 in 4 months, and your benefit will be reduced or adjusted accordingly. Now, if you apply for Social Security after your full retirement age, you will earn what they call delayed credits of 8% per year. If your full retirement age is 66 and you apply at 67, your benefit will be 108% of your primary amount. At 68, it'll be 116%, and so on. After age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after 70 to apply for Social Security. Now, I'm guessing you're probably not too interested in calculating by hand your average indexed monthly earnings or your primary insurance amount, and the reductions in credits for early or late filing, or the cost of living adjustments that could raise your benefit in the future. So you can find out approximately how much you can expect to receive in one of three ways. So one, you can refer to the annual Social Security statement. These are provided online now. Some of you on the webinar today may be used to have received an annual paper statement in the mail. The Social Security Administration does not do that anymore, I believe, for those that are under the age of 60. But you can get that information at this website provided, socialsecurity.gov/myaccount. You'll need to set up an account by answering a number of security questions, and then you'll be able to get in there to get your estimated primary insurance amount. Or the second one there, you can use the retirement estimator on the Social Security website. This calculator taps into your specific earnings history after you enter your personal identifying information, including your birthday, your Social Security number, your mother's maiden name. But don't worry, the site is secure. Please note that the annual statement and the retirement estimator do not factor cost of living adjustments into your age benefit. This means your actual benefit may likely be higher than they indicate on these websites I've provided. But our calculators do adjust for cost of living adjustments. So if you know your primary insurance amount, our office can help you calculate that. Now, the final option at the bottom of the page here is to try the link to use one of the three calculators they provide on the Social Security website. Now, I know that was a little bit of a fire hose. That's a lot of information, but a broad brushstroke with regards to how benefits are calculated and what you personally can expect in your situation. Now we're going to dive into the decision for when to apply for benefits. It's one of the most important and complicated questions that a retiree may have to answer. It can literally make the difference of thousands of dollars over your lifetime. Aside from the strict numbers of your benefit, it's important to realize that the decision and when to apply for Social Security depends on many factors unique to you. These include health status, life expectancy based on your personal and family health history, your need for income, whether or not you plan on working in retirement, and if you are a surviving spouse, whether you have other personal resources. The when to apply question is very complex and really requires customized analysis. But here's a few important points to remember. If you apply early, your benefit starts out at some fraction of your primary insurance amount and remains at that percentage for the rest of your life. It does not adjust to 100% when you reach full retirement age. Cost of living adjustments magnify the impact of early or delayed retirement because the annual cost of living adjustment is applied to either the lower or higher amount of benefit that you are receiving. This causes the disparity to increase with each passing year. Now, what I mean by that, simply put, a 2% cost of living adjustment for a $1,000 a month benefit is smaller than a 2% cost of living adjustment for a $1,500 benefit. That's what we're talking about. And that disparity can become pretty substantial over the course of a 10, 20, or 30-year lifespan or retirement years. The when to apply question impacts survivor benefits as well. In our office, we often encourage high earning spouses to delay benefits to age 70 because that will give the surviving spouse, whether it's them or their spouse, the highest benefit after one of the spouses passes away. Now let's look at some strategies for maximizing your own benefits. The first thing you can do while you still have time is improve your earnings record. First, check your annual statement to make sure your earnings record is accurate. Mistakes are rare because the earnings kept on file at Social Security were reported by employers when they submitted your Social Security taxes. But mistakes can happen, especially for self-employed individuals whose earnings records are taken from tax returns. The next thing to consider is to consider how you might be able to improve your earnings record. If you do not have 35 years of earnings, can you work a few more years so they will not be filled in with zeros? If you had several years of low earnings early in your career, can you work a few more years while you are in the peak of your earning years so that those low earning years will be replaced by higher earning years? I hope that makes sense. Even if you start receiving Social Security and continue to work, your earnings record will be updated. However, it's important to know that if you start receiving Social Security before reaching full retirement age, Social Security before reaching that age, if you earn over $19,560 a year, I believe that might have been the previous year. I think it's been adjusted a little bit up from that. $1 in benefits will be withheld for every $2 you earn over that threshold amount. But let me unpack that real quickly. I feel like I breezed through it and it's a ton of information. Simply put, if you retire at 62 and you've got a part-time job that earns over $19,560 and you are claiming Social Security, for every dollar that you earn, they will lower the amount you receive from Social Security by 2. Now, don't be concerned, and I'll talk about that here in just a minute. They will continue to update your Social Security benefits as a result, and it'll be fully adjusted at your full retirement age. But that is what will occur if you work prior to your full retirement age, but after claiming at the age of 62. Now, strategy number 2 for maximizing your Social Security is to apply for benefits at the optimal time. Now, we've been making a case today for delaying benefits because that will result in the highest lifetime benefit for you and your surviving spouse. But there is no one-size-fits-all answer to this question. The important thing is to apply at the time that's optimal for your situation. One important consideration in deciding when to apply for benefits is whether or not you plan to work. So back to what I was communicating just previously. If you apply before you turn full retirement age and you earn more than $22,320, that's the actual accurate number. I apologize for that previous slide. $1 in benefits will be withheld for every $2 that you earn over that amount. Now, it's important to know that this money isn't truly taken away. And just to reiterate, rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you applied later. This means that if some of your benefits are withheld due to the earnings test that I just communicated above, your new benefits will be higher as if you had started at 63 or the age of 64 or 65 instead of the age of 62. Please don't let the annual earnings test discourage you from working in retirement if you're considering it. The more money you can earn, the more money you will have. Social Security does not penalize you for working. Once the adjustment is made, you will end up with a higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. To avoid the earnings test entirely, just wait until your full retirement age or later to apply for your benefits. Strategy number 3 for maximizing your benefits is to coordinate spousal benefits. The goal is to maximize income for both you and your spouse while you're alive, and maximize income for the surviving spouse after one of you passes away. It can be quite complicated, but by understanding all of the considerations and doing some calculations, it is possible for married couples to come up with the right solution for their needs. Here at Link Wealth Strategies, we believe that a comprehensive financial plan includes the analysis of a married couple's combined Social Security benefits based on when they each apply. This, in the context of a conversation about family health history, other source of income, and personal financial goals, helps a couple make a decision they feel confident and at peace with. On the screen here, you can see an example of a chart we can provide our clients as we discuss the most effective ways for them to file for their benefits as a couple. To follow up on that idea of encouraging the higher earning spouse to delay filing for their benefits, you can see in this chart provided the difference made for a surviving spouse based on when the higher earning spouse files for benefits. Now, did you know that part of Social Security benefits may be taxable? Strategy number 4 for maximizing your benefits is to minimize this tax. You can minimize taxes on Social Security by lowering your other income, especially investment income. But you should be aware that municipal bond interest, which is usually tax-free, counts as income for the purpose of calculating the tax on Social Security benefits, as if the Social Security Administration hadn't made it complicated enough. Anticipate the required minimum distributions from your IRA is one thing that we suggest to folks, which may cause you to be in a higher tax bracket and may, as a result, cause some of your Social Security benefits to be taxable. Consider drawing down your IRAs before the age of 73. Consider converting a traditional IRA to a Roth IRA, which generates tax-free income and is not subject to required minimum distributions at the age of 73. Delay Social Security in order to reduce the number of years benefits are subject to tax. Reduce your expenses, pay down debt, and adopt a simpler lifestyle so you can live on less income. And continue to manage taxes throughout retirement, not just the first few years. As always, please consult with your tax advisor and about your own individual situation. But I must say, a little side note here, this is exactly why Link Wealth Strategies exists. We are a tax-intelligent financial planning firm that partners with incredible CPAs and enrolled agents who specialize not in just preparing the tax return, which so many people can do, including yourself and my own self online, but in planning your taxes so that you are the most efficient with income sources like IRAs, Social Security, so on and so forth, and you keep more money in your pocket rather than put it into the IRSs. Strategy number 5 for maximizing Social Security benefits is to coordinate Social Security with your overall retirement income plan. It's important to consider Social Security in the context of other retirement resources, like we talked about before, specifically in regards to taxes. Some of these resources might include pensions, IRAs, 401ks, the required minimum distributions you'll need to be taking at age 73, your overall investment portfolio, and your plans for working in retirement. All of these resources should be coordinated, woven together, a puzzle of sorts, to give you the income you need for the rest of your life. But please don't be afraid to ask. It can be pretty complex. Retirement planning is easy, though, we think, when it's a matter of stashing part of your salary into a 401k or IRA as you accumulate. It's very easy to discipline yourself to save. But when the time comes for you to convert your nest egg into an income stream that is hopefully tax efficient, you want to make sure it doesn't run out and that you're being the most wise with those dollar bills. Social Security may be the bedrock of your retirement income plan, but it must be coordinated with the other resources to give you the stability and security that you've worked hard for. Now, I know we've covered a ton of information. I do hope you've been able to glean just a few things, or maybe it's piqued your interest, created some questions around certain things that might apply to you. Some of the questions you may have, obviously, when should you apply for Social Security? What if you keep working and make over that threshold of 22,000 that we talked about? What if you've already applied? Are there any options available to you if you want to make an adjustment? How much will your benefits be? How can you coordinate your spousal benefits? What's the best long-term strategy for your situation? And what should you do next? Here at Link, we'd be glad to help you consider each of these questions individually and help you come up with a plan for your personal situation. Social Security is too important for guesswork. It used to be very, very easy for a lot of baby boomers' parents, but it is not so much that way today. Let us help you protect your nest egg and maximize your income in retirement. Now, I'd love to defer to Creighton. If there are any particular questions in the chat, I'd be happy to address those. It does not look like we have any questions today. I guess I was as clear as could be. Well, as you can tell by the breadth of information that I've shared today, that Social Security is very complicated. The US government doesn't often make things simple and straightforward. I guess that's why I have a job, but that is what we do. That's what we specialize in here at Link Wealth Strategies, is helping people put the puzzle pieces together of their situation. Chart a course, and as life necessitates, adjust appropriately so that they live a life of peace. Our hope is that folks have peace of mind with their financial situation. We think that only in having peace of mind are you able to have true joy. And we hope for those folks that we work here at Link Wealth Strategies. Hey, thank you for your time today. I sure appreciate it. And I hope that you found this information helpful as you move forward in your retirement planning journey. Have a great day.